Hello, and welcome to Cherry Bekart's Technology Podcast. I'm Megan Hutchinson, a tax partner in Cherry Bekart's Technology Group. And here today we have Lauren Stinson and Don King from our Sales and Use Tax Practice. Lauren, Don, welcome. Could each of you start by introducing yourselves to our audience?
Yeah, good morning, everyone. I'm Lauren Stinson, and I am a tax partner in our SALT group, and I lead our Sales and Use Tax Practice.
Hi, and I'm Don King. I'm Indirect Tax Director, and I am located in Nashville office. And I recently joined Cherry Bekaert about 3 months ago, and spent the last 11 years in technology.
Awesome. Well, great. Well, today we will be talking about what you in the technology space could be missing with your sales and use taxes. So let's get into today's discussion. Lauren, can you start by setting the stage a bit and give us a little bit of overview of the issues that you see technology companies facing when it comes to sales and use tax?
Sure. So, at this point, we're in 2022, and we are 4 years into, 4 years after the Wayfair decision, which, if you're not familiar with Wayfair, Wayfair was a Supreme Court decision that allowed states to impose sales tax obligations on companies, not only if they had a physical presence in the state, but the new aspect is if they had an economic nexus or economic presence in the state. And what that means is that if a company sells enough into a state, and every state defines enough a little bit different, they could have sales tax obligations. So the Wayfair decision was in 2018. We're now 4 years into it. And what we have seen is that a lot of technology companies they've come to realize that Wayfair exists, but they may not actually be doing anything about it. They've been very focused on growing fast, really building their company, and leaving some of the issues, including sales tax, to the side. So, very focused on growth over profitability. But now we're starting to see technology companies really, looking at their sales tax obligations, especially in the context of a transaction where they're going through due diligence or they're getting ready for a transaction, and this sales tax is starting to come to light. So that's where we're seeing a lot of tech companies, really facing their sales tax obligations for the first time.
Yeah, I think a lot of technology companies have come to the realization that they can't have their head in the sand much longer, and they're finally starting to get around to looking at this. So, Don, when your company is ready to tackle these issues, where should they start?
Well, as Lauren mentioned about Nexus, that's one of the first places you have to start. You have to determine whether or not you have a filing responsibility with the state. And give you a little background. Back in '92, there was a Quill decision that basically identified that physical presence causes nexus. That means if you have property in a state, an employee in a state, you drive your own trucks in the state, so forth, that would end up causing physical presence. And with that state, you would be required to register, collect, and remit sales tax on items that were taxable in that state. And Wayfair, as Lauren mentioned, 4 years ago in 2018, that case came out, and the U.S. Supreme Court determined that physical presence still exists, but they expanded it to include economic presence. So a lot of states went ahead and grabbed hold of that, and they set thresholds. Some of the states have a threshold of $100,000 per sales in a year, or potentially 200 transactions that would cause you to have economic presence or nexus with that state, and then you would have to register and collect. Some states, like the larger states, California, New York, might have higher thresholds, maybe 500,000, but each state has put in their thresholds for determined economic presence. The thing you have to look at is your sales. As you're expanding your sales into all these different states, you could generate nexus, and the states are getting aggressive, and they're coming after companies, trying to get them to register and collect tax. The state would rather collect it from one company than try to collect the tax from thousands of customers. So they focus in on the company to get them registered and collect and remit and take it all in one shot. The other thing you have to keep an eye out for, this trend right now, is we have remote workers So now all of a sudden you have employees located in different states, and that could cause you nexus as well. And that's on the physical side of it, because now you have, an employee in a state. So as you go through that, you have to determine where do you have filing responsibility, and what should you do in that situation, and how long does that filing responsibility exist? How far back does it go? Did you have nexus 3 years ago because of economic presence, or even 4 with Wayfair, or did you just start getting nexus? So you need to review those thoroughly, and make sure you understand what you have.
And I think it's really important to know, and this is where a lot of people get confused, is that physical nexus will always trump economic nexus. So if you have physical nexus, meaning you have an employee in the state, even if you don't have economic nexus, you will still have sales tax obligations because you have that physical presence. So just remember, physical presence, even though Wayfair happened, physical presence is still, the number one rule of the land.
Yeah, it did not disappear. It's still there.
Yeah. That's super helpful. I think a lot of times where technology companies kind of get their brains confused about sales tax and what they're selling is, with sales tax, you often think of a tangible good, right? And a lot of technology companies are not selling a tangible good. So, how do you determine which products are subject to tax and in which state when you're talking about a technology company? What are those special issues that they should be considering?
Yeah, that's a great question, Megan. And that's something that we spend a lot of time helping, technology companies, trying to define exactly what they're selling. Just the sheer growth of what companies sell, these products and services, didn't exist 5 years, 10 years ago. And just trying to get our arms around, what exactly they're selling and fitting it into tax law that is probably 5 or 10 years old, that doesn't even come close to defining, what, how to match that, old tax law to new products and services. So that's really the challenge. So we spend a lot of time, reviewing contracts. We have to get to a very granular level of what exactly that product does, how it's delivered. So there's different tax laws for electronically delivered software, or software as a service. There's different tax applications if there's a license or a software. Just so many different things to consider when you start talking about technology products and services. That is the one of the biggest challenges. It's kind of like fitting a square peg in a round hole.
Yeah, I think one of the items that you give you an example, you could end up having a digitally delivered book, and that book is considered digital products. And a lot of states tax digital products, and they treat it differently than software. And I was explaining to Lauren the other day that a digital book could become software, which could be the difference in taxability. And the difference between that is, if you think of a digital book, you can click on a button and it goes to the page you're looking for, or you can save where you're at and click to that. And that's nothing really important, and there's no interaction that occurs there. It just takes you there, and that's considered a digital book. But if you have the ability to take that book and, based on different criteria, change the story of the book, now all of a sudden that becomes software. A video game would be a perfect example of that. You have the ability to change the outcome of a video game. You're interactive and everything. So you have different rules, as simple as that. You have different rules between a digital book that you can't change the story and one that you can, and that changes the taxability in different states, depends on their tax rules.
And the biggest, and another big issue is that every state has different laws. So, not only are you trying to figure out the characterization and taxability in one state, you actually have to figure it out in all 50 states.
Yeah, another item that's very important to keep in mind is there's also a difference between streaming and downloading that could change the taxability of what you sell as well. If you have a subscription, it may be different than the sell of a software or sell of a product.
So what you're saying is this is a very complex matter. Every company is going to be a little bit different depending on the service or the product that they're actually providing, and then needing to look at every state's approach to that. I think a big challenge that companies are facing is, how to source this. How do they determine how to source their revenue to whatever state, and looking at their particular taxability. So Don, how are they able to determine this from a sourcing perspective?
Yeah, that's always a challenge. When you look at sourcing, especially on digital, when you look at sourcing of physical products, you source it generally based on where it's shipped to. You have different rules, it might include where you ship from, but where you ship the product to, you know exactly where you're shipping it to. You have the address of the customer, you deliver it to them, and generally that's the rule of thumb for tangible personal property. But when you're looking at digital, it gets a little bit more complex, because you have a customer out there that may not know where they're physically located at. And so the general rule of thumb is the address of the customer is supposed to be the rule of thumb for where you source it at. Some states are getting aggressive and trying to say, well, wait a second, it could be IP address, or it could be your billing address, trying to show that, maybe they're not physically located where they say they're located at. So how do you determine where they truly are located at? The other part of it is, you are located in a state and you're delivering to another state. Where's that benefit of that service, or that software or whatever? Where's the benefit of that occurring? If you think of SaaS could be located on a computer in one state, and then you have a customer in another state. One state may try to say the benefit of services being received in their state, and that's where it should be sourced to, while another state that says, no, wait a second, that software is here. We want to pick up that use of that software here. There's items out there called like MPU, which is multiple points of usage. That is very handy for companies when they end up having employees located throughout the United States. They end up buying software. Generally, they're going to be billed based on their headquarters or where there's the account is located at. But their employees that are using it are located throughout the United States. So some states allow an MPU exemption where the company can actually buy the items tax exempt, buy the software tax exempt, and then determine where their locations are at, their employees based on users. And then they can allocate that and then say, okay, I'm going to source these transactions to my home state because 75% of that is here and 25% is in another state. So there's a variety of ways of handling on the sourcing. Yeah, it's really a challenge, especially with digital. How do you prove where someone's at? And that's a major challenge for companies.
And just to add to that a little bit, especially when you're selling over the internet direct to consumer, and you've got a shopping cart that is driving the tax function. A lot of companies we're seeing they're not even collecting a proper zip code to be able to pull the right sales tax rate. So a good example is, I live in one zip code, it's 30005. Well, our office is, a mile and a half down the road, same zip code, but we are in two different taxing jurisdictions. So, if I'm buying something over the internet, they don't know, the technology doesn't know what rate to charge me, because it could be, one of a multiple rates. So, just even getting the information that's needed to properly pull the right sales tax rate is a big challenge that we're seeing.
And that also impacts a variety of things. And as myself, as an ex-auditor, when I started my career, I've been a consultant. I've also been in the corporate world, especially the last 11 years in tech. But if you have the wrong address, or if you can't get the right tax ability or tax rate for the customer because you don't have the right location where the customer is located at, you have two things that occur. One thing is future audits. You could be dealing with auditors that are going to assess you. Colorado is a perfect example. Some local jurisdictions, if you don't have address, they try to grab everything within the zip code and pull that into even though it might be cross-border into another city, and that other city meanwhile is doing the same thing, and all of a sudden you potentially have tax liability in two states and two cities, and you can't prove where they're at because you don't have that address. So that address is very, very important. The other thing is customers. You basically, if you charge a customer tax, if you overcharge them, more than likely you're going to get a call from them. They're going to be complaining. You have to deal with that. Your consumer services group is going to have handle that call. If you're undercharging them, they probably aren't going to call you up. But you know what? That auditor is the one that's going to end up, addressing that for you.
So we didn't even hit the tip of the iceberg, but you can quickly see how complicated sales tax is for technology companies.
Yes, I was just about to say, I feel like we have just scratched the surface. Lauren, Don, thank you both for joining us on the podcast today. Like I said, we've just scratched the surface, so I look forward to having some more discussions with you about how the Cherry Bekaert sales and use team can help keep the industry, the tech industry, in compliance. So thanks for being here, and thanks to you all for joining us. Thanks.
Thank you.
Thanks, Megan.